from 1945, all the world's currencies were like this juicy fruit, each independent juicy fruit latched and interrelated to one another with the holy link of the gold through the US dollar. It was the Bretton Woods Agreement that was signed in 1945. But unfortunately, come 1971, we have President Nixon unplugging the relationship between gold and the US dollar. And that steered way to what we call as the fiat currency, which we shall see today. The fiat currency has its own peculiarities, which was until then not clearly exposed. The ability to breathe in inflation. That is because fractional reserve banking was a byproduct of unplugging this dependency with gold and the US dollar. This inflation we need to understand very clearly because it is very elusive. It doesn't meet our eye. So regularly, when any nation publishes its figure called as the CPI, how do we really feel connected to that number? Is that number even experimentally validated? Is there a number that we can be more assured of rather than looking at a number like the CPI, which the government regularly publishes, to make us feel comfortable that we are doing and we are thinking much ahead than what the inflation can actually be instead of a published number? What's in your basket? It's not just money printing. In the US, housing, healthcare, and services dominate the CPI basket. Rents and medical costs rise steadily. So US CPI looks higher even if global demand for dollars is strong. In India, food has the largest weight. If harvests are good and food prices stay low, India's CPI can appear smaller. Even though structurally the rupee loses value faster than the dollar. Think of it like two grocery carts. The US cart is full of rent and hospital bills, while India's cart is full of rice, vegetables. So overall are different carts and different inflation numbers. The short-term CPI versus the long-term currency erosion is something that we need to pay attention to. CPI is a short-term measure of price changes. It's influenced by local supply-demand shocks. Example, oil, housing, etc. The currency erosion, like INR weakening over decades, is a long-term structural phenomenon driven by money supply, growth, and global trust. So it is very much possible in a given year, US CPI might be higher than India's. But when looked over decades, the rupee will lose more purchasing power against the dollar if the geopolitical structure remains as is. The global demand buoys USD outside CPI. So even if US domestic CPI shows 3 to 4%, the world still demands dollar for oil, trade, and reserves. That external demand acts like a pressure valve. It prevents hyperinflation in the US because excess dollar gets absorbed globally. However, India's rupee doesn't have that privilege so far. It's confined within its borders. So inflation pressure shows up if rupee weakens versus the USD, even if the CPI looks modest. This rupee weakening over the USD, if it is happening gradually, then it doesn't affect. However, if it happens swiftly, then there will be a huge difference in the overall inflation of India. How do we measure this erosion of our currency's flesh? Governments publish the CPI, the Consumer Price Index, and tell us that's the inflation number. But CPI comes with its own problems. First, it's built on an average basket of goods and services that may not reflect your real expenses. Your life's inflation is not the same as your neighbor's. Second, CPI mixes two forces that shouldn't be confused. The natural demand-supply shifts, like when tomato prices spike in summer, and the deeper monetary inflation, which is the slow thickening of every currency's shell. Thirdly, CPI itself is only statistical. It's based on a sample and not the entire economy. And sample can definitely miss reality. That's why CPI is always debated, but never undisputed. And this raises a bigger question. If every good and service has its own demand-supply driven price changes, can a single average statistic truly measure the hidden decay of our purchasing power? Or do we need to look for a market-driven compass that can give us a more relatable and a reliable signal? Yes, and the answer lies in the bond market. See, higher inflation means higher yields. Investors want to be compensated for the money they lend. If India's inflation is approximately 6% and US inflation is approximately 3%, then Indian government bonds must pay more than 6% to attract buyers, while US bonds only need to pay above 3%. This is exactly like a shopkeeper charging more interest when prices are rising faster in the neighborhood. The credit risk and currency risk is another aspect. See, the US borrows in dollars, the global reserve currency. everyone trusts the US. It will be able to repay because it can anyhow issue more dollars when the world wants it. The India borrows in rupees, which is not used globally. Foreign investors demand a higher yield to cover the risk that the rupee will lose value against the dollar over time. So we can probably have a mental model that says that, think of it like, we lend it to a cousin who earns in a strong, stable business versus another cousin with a smaller local shop. You would ask the second cousin for a higher interest rate, isn't it? Third point is, in the bond market, the depth of the market and demand comes to play. The US Treasury market is the deepest, most liquid bond market in the world. Every central bank, pension fund, and investor want treasuries. So demand is strong, and hence the yields stay lower. In India's bond market, it is smaller, less liquid, and not enough to attract buyers globally to the extent in which the US operates. And hence the government has to offer higher returns. So overall, if you see, the nation's currency structure has a very important role to play when it comes to inflation. And though we have two parameters, the CPI and the bond yield, since CPI is statistical, whereas bond yield is more market driven, where we have participants who are into businesses of several kinds, who have goods and services that they deal with of several kinds and a broader spectrum in nature, the 10-year bond yield is probably a closer reality of how we should plan for inflation.
We can trust this figure, the 10-year bond, more accurately because we have people and traders from all walks of life who deal with variety of goods and services who invest in the treasury bonds. And hence, the percentage, the return on investment on the treasury bonds can to some extent say is a more real figure of what the inflation is that we can anticipate in 10 years from now. So the next important question is, now that we know that treasury bonds are a vehicle that can actually help us to retain the purchasing power, so as an investor, we are now posed with a set of problems. So is it a good idea to store all our free currency as treasury bonds? Is there a way to invest money so that we get more than the treasury bonds? And if so, what are all the various angles that we should cover to make sure that we are in the right track? This is coming up in the next section. Stay tuned.